Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. First question is from David. He asks, I sold my rental income properties, but I still want income. Where should I invest? I don't feel safe in stocks. All right, David, you're not alone. A lot of retirees feel the same way. And I appreciate that you're thinking about this in terms of income rather than just returns. That's exactly the right mindset for retirement. The good news is you have options. And the even better news is that many of these options can provide income that rivals or exceeds what you were getting from rental properties without the 2 a.m. phone calls about broken water heaters. If you still want to stay partially in the stock market, one strategy is high dividend blue chip stocks, companies with long histories of steady dividend payments. Now, these are firms like utilities, consumer staple companies, established brands that have paid and increased dividends for decades, sometimes even through recessions. Even if stock prices fluctuate, the dividends tend to stay consistent and often increase over time. So that can create kind of dependable income without selling shares. For example, there are companies known as dividend aristocrats that have increased their dividends for 25 consecutive years or more. These aren't speculative tech startups. They're established, profitable companies that generate cash and return the cash to the shareholder. Now, while the stock price might move up and down, the dividend stream remains remarkably stable. If you want to be more conservative and prioritize principal protection even more, there's a whole universe of income-generating investments. First, there's bonds, which pay a fixed interest on a schedule. Investment-grade corporate bonds, municipal bonds, even certain government bonds that can provide attractive yields while keeping your principal relatively safe. The key is understanding credit quality, duration, and how to ladder maturities to manage interest rate risk. Then there are preferred stocks, which behave more like bonds than common stock they pay scheduled dividends. Preferreds typically offer higher yields than bonds from the same company. And they sit higher in the kind of capital structure, meaning they get paid before common stock dividends. So many preferreds are issued by banks and financial institutions with strong balance sheets. There are also REITs, real estate investment trusts, which invest in rental real estate, just like your properties, except they handle all the management and you just collect the income. REITs are required by law to distribute at least 90% of their taxable income to shareholders, which is why they tend to offer attractive yields. You get exposure to the real estate income without being a landlord. And then there are annuities, which I know some people are skeptical about, but hear me out. Not all annuities are created equal. Fixed index annuities, for example, can provide guaranteed income for life with your principal protected from market losses while still having some growth potential tied to market indices. Now, for someone who wants absolute certainty that they'll never outlive their income, a properly structured annuity can be a valuable piece of the puzzle. The beauty of working with an income-focused advisor is that we can create a portfolio that combines several of these investments, each serving a different purpose to generate a diversified stream of income. Maybe 30% high quality dividend stocks for growth and rising income, 30% in bonds for stability and consistent interest, 20% in preferred stocks for higher yield, and 20% in REITs for real estate exposure. The exact allocation depends on your income needs, risk tolerance, and overall financial picture. All of these can generate income that rivals, sometimes exceeds, rental property income without the headaches or tenants or repairs, and your principal is invested in actual assets with value, not just sitting in a savings account earning nothing. That was a great question. And if you have a question and you'd like me to answer it, you can email that question to us. Email it to poollocke@poollocke.com. Moving on to our second question. This is from Karen. She says, I watch your videos and hear you talk about income generating investments. But how do I know what's right for me and when the right time is to invest? All right, great question, Karen. And it's one I get asked all the time, so I'm glad you brought it up. The timing depends heavily on whether, one, you've saved enough and are nearing retirement, or two, you feel behind and still need capital appreciation. So let me address each scenario. Ideally, if you're in good shape for retirement, meaning you've accumulated sufficient assets and you're within 10 years of your retirement date, you want to begin transitioning into income-producing investments. Why? Because the perfect time to transition is when two things happen simultaneously. The market is high and interest rates are high. That gives you more principal to move into income investments and higher yields when you do it. So you're selling stocks or capital appreciation focused assets at peak valuations and locking in attractive interest and dividend rates. But since that perfect alignment only happens about 25% of the time, starting early increases your odds. Now you can transition gradually, moving a portion of your portfolio each year, which helps you average into income investments over time rather than trying to time the market perfectly. Here's why this matters. If you wait until the day you retire to start thinking about income, you might be forced to transition during unfavorable conditions. So maybe the market just crashed, so you're selling low, or maybe interest rates are at historic lows, so the yields available are unattractive. By starting to the transition 5 to 10 years early, you give yourself flexibility to be opportunistic, moving more money, when conditions are favorable, moving less when they're not. Now, if you're behind, if you haven't saved as much as you had hoped and retirement is approaching, you may need a hybrid situation. This is where investments like high dividend growth stocks become valuable. They give you both income and potential principal appreciation. You're not choosing between growth and income, you're getting both. Companies that consistently raise their dividends tend to see their stock prices appreciate over time. So you can build wealth while also generating cash flow. If you're way behind and retirement is still 15 or 20 years away, you may have to stay more heavily in growth-oriented investments and hope for favorable markets. But even then, I'd encourage you to think about quality. Even growth investors can focus on companies with strong fundamentals, consistent profitability, and eventually dividend potential. That sets you up for an easier transition later. But right now, and this is important, with interest rates still relatively high compared to where they've been for the past decade, and with the market near all-time highs and potentially overdue for a pullback, it's actually a smart time to evaluate a transition into income-focused investments. You can lock in attractive yields on bonds, preferred stocks, and other income investments while simultaneously reducing your exposure to potential market volatility. I'm not saying to liquidate everything tomorrow, but if you're within a decade of retirement, or if you're already retired and still heavily in growth investments, now it's an excellent time to sit down with an income-focused advisor and create a transition plan. Map out how much income you'll need, what investments can generate that income safely, and what timeline makes sense for making the shift. And here's what a lot of people don't realize. Transitioning to income-focused investments doesn't mean giving up all growth potential. Many income-generating assets appreciate over time. Dividend-paying stocks tend to increase in value as their dividends rise. Bond values fluctuate based on interest rates. REITs can appreciate as their property values increase. You can still build wealth while generating income, but your primary focus shifts from capital gains to cash flow, which is exactly what you need in retirement. Two great questions today. Thank you so much. If you would like to send in your question, we'd love to get it. Email it to poolelock@poolelock.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend.